Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at PayPal.
If you find our talks useful, please consider subscribe, like, and comment underneath.
We'll actually have a really fascinating setup today. It is one of those classic market disconnects
Oh, totally.
where the price on the screen and the actual business on paper just seem to be living in two completely different realities.
Yeah, let's just go ahead and address the elephant in the room right away, because if you pull up a stock chart of PayPal right now, it is, well, ugly is probably putting it politely.
It has been absolutely torched.
Torched is the word. We are talking about a stock that is down almost 39% just since August of 2025. It's sitting right around $41.65.
Right, and just to put that into perspective for everyone listening, that is down over 45% from its 52-week high.
Exactly. It's trading near prices we genuinely haven't seen since the IPO era. If you are just a casual observer walking past a trading screen, you look at that chart and think, oh, that company's dying.
You would think it's a business in total freefall.
Right. It looks like a classic value trap, something that looks cheap but is actually just permanently broken. But that is exactly why we're here today. Is this a trap, or is this actually the sale of the decade?
That is the multi-billion-dollar question. And I think to really answer it, we have to sort of force ourselves to look away from that giant red arrow on the stock chart for a second and actually look at the fundamental business performance.
Because the contrast is jarring.
It is jarring. While the stock was getting absolutely hammered, the company actually reported 2025 revenue of $33.26 billion.
Wow.
And that is actually up 7% year over year.
Okay, so revenue is growing, but usually, when a stock drops that aggressively, it's because even if sales are up, the profits are completely vanishing. Like maybe they're just burning cash to buy that growth.
See, but they aren't. That's the crazy thing here. Non-GAAP earnings per share reached $5.37 in 2025.
Which is up, what, from 2024?
That is a 16% increase from 2024. So, just pause and think about that setup for a second.
All right.
You have a stock price collapsing by nearly half, but the actual earnings per share are growing at double digits.
That is a massive divergence. Usually stock price follows earnings eventually. If earnings go up, the stock goes up.
Exactly.
So we have the market pricing this thing like it's a melting ice cube, but the actual fundamentals are screaming growth company. Why is the market getting this so wrong? Or are we missing something?
It really sets the stage for what I call the sleeping giant thesis. The market is acting purely on fear and sentiment right now, and they are completely ignoring the operational turnaround that's actually happening under the hood.
Because there's this pervasive narrative that PayPal is just old tech.
Right. But the numbers suggest a major pivot is happening.
Well, let's dig into that turnaround then. Because we have definitely seen tech companies grow revenue but lose money doing it. That whole growth at all costs model. Is PayPal still stuck in that mode?
No, and that is the biggest shift we've seen under their CEO, Alex Chris. The focus has completely pivoted from growth at all costs to strictly profitable growth.
Okay.
And there was one specific metric that proves this, which I actually think is the most important number for investors to watch right now. It's called transaction margin dollars.
Let's unpack that, because I see that phrase tossed around in their financial reports, transaction margin dollars. But why is that the holy grail here? Why not just look at total revenue?
Because revenue can be really misleading, especially in the payment sector. Think of it this way. If PayPal processes a payment for you, they collect a fee, but they also have to pay a fee to Visa or MasterCard or whichever bank is involved.
Those are the transaction costs.
Exactly.
Right. So if they process $1 billion but have to pay 99% of it to Visa, their top-line revenue looks massive, but they actually keep almost nothing. It's like selling dollar bills for 99 cents.
That's the perfect way to look at it. It's empty calories. But transaction margin dollars measures what PayPal actually keeps after paying those transaction costs to the banks and networks.
Ah, okay.
And that number specifically rose 6% to $15.4 billion.
So they aren't just processing empty volume anymore. They're actually making real money on the transactions they facilitate.
Precisely. It proves they aren't just relying on low-margin volume fluff just to make the headline revenue look good for Wall Street. They're becoming way more efficient. They are shedding the bad business and focusing entirely on the profitable business.
And a big driver of this efficiency, I know, is a new feature they've been rolling out called Fastlane.
Yes. Fastlane is huge.
I've read a bit about this. It's basically their answer to the whole I forgot my password and I really don't want to create another account problem, right?
Essentially, yes. It is a one-click guest checkout innovation.
Hmm.
And you really have to understand the consumer psychology here to get why this matters. How many times have you been buying something on a random website, you get to the checkout screen, they ask you to create an account, and you just close the tab?
Oh, all the time. If I have to remember a password, or worse, fill out a massive form with my address and credit card number on a tiny phone screen,
You're done.
I am completely out. It is just way too much friction.
Exactly. And that is every merchant's absolute nightmare. Cart abandonment.
Right.
Fastlane completely solves that.
Right.
It allows you to check out as a guest, but because PayPal already recognizes your device and your email on the back end, it just autofills everything securely. The stats coming out on this are just incredible. It boosts merchant conversion rates by 50%.
50%. That is massive. I mean, if I'm a merchant and you tell me I can save half the sales I'm currently losing just by adding a PayPal button, I'm signed up yesterday.
And that right there is the moat. Investors constantly worry about Apple Pay eating PayPal's lunch, but Apple Pay is dominant mainly on the iPhone. Fastlane gives PayPal a distinct advantage on the open web, on individual merchant sites, on Android devices, on desktop.
Places where Apple doesn't have that same operating system stranglehold.
Exactly. It completely protects their territory.
It's so interesting because for a while, the narrative really was that PayPal was just legacy tech, like they were the granddad of online payments. But a 50% boost in conversion is not legacy. That is cutting edge.
It really is.
Right.
And that operational efficiency is bleeding straight down into their cash flow. Which brings us to the financial fortress part of the thesis. Because if you thought the earnings were good, you have to look at the cash.
Yeah, let's talk cash. Because in this current economic environment, cash is absolutely king. How much are they actually generating?
In 2025, PayPal generated $6.5 billion in free cash flow.
$6.5 billion. That is a staggering amount of liquidity.
And to give you some context on that, let's look back at 2019. This is before the pandemic, back when
Yeah.
everyone loved the stock and it was trading much, much higher. Back then, they only generated $3.37 billion.
Wait, really?
Yes. They have nearly doubled their cash generation power in 6 years.
That is wild. They have literally doubled the cash machine. They are twice as efficient at generating cash, and yet the stock is sitting at 10-year lows. That really highlights that disconnect we talked about at the very beginning of the show. So what are they actually doing with all that money? Are they just sitting on a dragon's hoard of cash?
Definitely not. They are aggressively returning it to shareholders. They currently have a massive $15 billion share repurchase program active.
15 billion. That is a really significant chunk of their total market cap at these depressed prices.
It is. They are basically eating up their own shares on the open market. And this is crucial for you as an investor to understand. When a company buys back its own stock, it permanently reduces the number of shares available. So even if the total profit of the company stays exactly the same, your individual slice of the pie gets bigger.
It's like if we ordered a pizza cut into 8 slices, and then the chef came out and just removed 2 of the slices but left the exact same amount of cheese and pepperoni distributed on the remaining ones. My slice just got a lot denser.
That is the perfect analogy. And on top of that denser slice, in late 2025, they initiated their first ever quarterly dividend.
Now, that is a huge psychological shift. Initiating a dividend usually signals a company moving from being a hyper-growth speculative play to a mature cash cow.
It does.
And
And it attracts a completely different class of investor.
Right, because when you pay a dividend, you start getting the income-focused funds.
Exactly. The pension funds, the value investors.
Yeah.
You move away from the momentum chasers who just dump the stock the second it stops going up 20% a month. It stabilizes the entire shareholder base. And more importantly, it signals that management firmly believes the stock is undervalued.
Because if they didn't, they wouldn't be buying back $15 billion worth of it.
Precisely.
It's basically management putting their money where their mouth is. They're telling the street the market is wrong and we are going to buy our own stock at a massive discount.
Exactly.
But we do have to look forward too. Buybacks are great and operational efficiency is great, but you need a real growth story to get the valuation multiple to expand again. We touched on Fastlane, but what else is actually in the pipeline? What about Venmo? Because I feel like Venmo has been this massive user base. I mean, everyone uses it to split dinner bills, but they've never really figured out how to make serious money from it.
That is finally changing. Venmo revenue is actually up 20%.
Really?
Yes, it is finally monetizing. And a big part of their future strategy is integrating it with OpenAI.
Wait, Venmo and OpenAI, how does that even work? Is that just slapping an AI sticker on the app to sound trendy for investors?
It's actually a lot deeper than that. It's about making Venmo smarter and more seamlessly integrated into your daily financial life. But the much bigger AI play for PayPal is actually a recent acquisition they made called Symbio. This just happened early in 2026.
Okay, I actually haven't heard much about Symbio. What's the angle there?
So think about where the entire concept of online shopping is going. We are rapidly moving toward a world of AI agents. Eventually, you might not go to a website to shop yourself. You might just tell your AI assistant, hey, find me a pair of running shoes under $100 that are good for flat feet.
Okay.
And the AI will just go out to the web, find them, and literally buy them for you.
Honestly, slightly scary, but incredibly convenient. I can totally see that happening.
Right. But for that to actually work, the AI needs a payment rail that it trusts. It needs a secure digital wallet. PayPal wants to be that trust layer. By acquiring Symbio, they are strategically positioning themselves to be the default wallet for all AI-mediated shopping.
That is fascinating. So instead of me manually clicking the PayPal button on a website, my AI agent just uses PayPal natively because it's the most secure API for it to connect to.
Exactly. It secures their relevance in a future where humans might be doing way less of the actual clicking. It ensures they don't get cut out of the transaction flow just because the consumer interface changed.
That is a really smart hedge against the death of the traditional checkout button. What about the other big battleground we hear about? Europe. I saw some notes regarding the EU Digital Markets Act, and usually when I hear regulation and tech companies in the same sentence, I immediately think bad news.
In most cases, yes, but this is a huge, totally under-discussed catalyst. In this specific case, the regulators were actually helping PayPal. The act has basically forced Apple to open up the NFC chip on the iPhone in places like Germany and the UK.
Okay, the NFC chip. That's the hardware inside the phone that actually lets you tap to pay at the grocery store register, right?
Yes, and for years, Apple completely locked that down. Only Apple Pay was allowed to use that chip. If you were a PayPal user or you wanted to use a specific banking app, you physically couldn't tap your iPhone to pay.
Because Apple wouldn't let them access the hardware.
Right. But the EU finally ruled that was anti-competitive. So now, PayPal can launch its own wallet tap-to-pay features directly on iPhones in Europe.
That is massive. That means PayPal can finally compete in the physical retail world, not just online. They can go head-to-head with Apple Pay right at the coffee shop counter.
It is a total game changer for their geographic expansion. It opens up an entire market, the physical point-of-sale market, that was completely walled off to them before.
Okay, so let's just summarize the bull case here for a second. We have rising revenue, we have massive cash flow that has doubled over 6 years, we have huge $15 billion buybacks, we have a new dividend, we have AI integration preparing for the future of shopping, and the brand new regulatory opening in Europe.
Yes.
This all sounds incredible. So why is the stock down 45%? We have to be completely fair to the bears here. What are we missing? Why does the market seemingly hate this stock right now?
It is a very fair question to ask. The bear case really revolves around three main things: competition, guidance jitters, and pure sentiment.
Let's start with competition, because it always comes back to Apple, doesn't it?
It does. The overarching fear is that Apple Pay is just too easy, and it will slowly, inevitably erode PayPal's margins. Even with Fastlane rolling out, the bear argument is that because Apple literally owns the phone in your pocket, they have an unfair structural advantage that will eventually grind PayPal down over time.
And that is a valid fear. I mean, in payments, friction is everything, and Apple is the absolute king of removing friction. And what about the guidance jitters?
There's a lingering fear on Wall Street that the 2026 outlook might fall short of the really high expectations that were set a few years ago. There have been various investigations and questions about their future growth rates. The market absolutely hates uncertainty. And if there is even a 1% chance they miss their forward guidance, investors just get incredibly skittish.
And that perfectly feeds into the sentiment issue, what you called the collapse narrative earlier.
Exactly. Once a stock starts falling, people just invent reasons for why it's falling. It becomes this nasty self-fulfilling prophecy. Retail investors pull up the chart, they see the red line going down month after month, they get scared and they sell.
Which just pushes the price down even further.
Right, which scares even more people into selling.
But your counter argument to all of this is that at $41 a share, this fear is already entirely priced in.
That is the key to the whole thesis. If the stock were trading at 50 times earnings, like a typical high-flying tech stock, I would be terrified. But it is trading at decade-low PE ratios. The market is quite literally pricing it as if it's going out of business tomorrow.
Right.
Even if they just grow modestly, the stock is currently undervalued. They have a completely robust balance sheet to weather any of these storms. The downside risk seems very limited at these levels compared to the upside potential.
So let's look at what the pros are saying.
Right.
Is the smart money starting to wake up to this value? What does the analyst consensus look like right now?
It is actually starting to turn.
Yeah.
Out of the 29 analysts covering the stock right now, we have 20 buys, 6 holds, and only 3 sells. The overall consensus rating is a moderate buy.
Well, that is a lot more bullish than the daily stock chart would suggest. What kind of price targets are they throwing out there?
The median one-year target is $71.54.
$71. That is what, almost a 70% move from $41?
It's about a 72% move, yeah. Even the more conservative estimates out there are seeing about 28% upside. And if you look at the forecast from 2147 Wall Street for the end of 2026, they actually have a target of $89.76.
Wow, $89 compared to 41? That would be more than doubling your money.
It just goes to show that the analysts are absolutely seeing the disconnect. The market mood is finally shifting from pure panic to people stepping back and saying, wait, isn't this getting a little too cheap?
It really feels like we are at that inflection point. The bad news is fully out there, the price has been smashed down, but the actual internal numbers are turning positive. So let's bring this home for the listener. What is the final verdict? If we are actively building wealth, where does PayPal fit into a portfolio?
I am giving this a bullish score of 8 out of 10.
8 out of 10. That is high confidence.
It is. And here's the elevator pitch for why. PayPal is a lean, highly profitable sleeping giant. It has 220 million active users. It operates in 200 countries.
Yeah, it's huge.
This is not some speculative startup trying to find product market fit. With projected 2026 revenue of over $36 billion and the overall digital payments sector still growing at a 17.5% compound annual growth rate, the macroeconomic wind is very much at their back.
And the valuation provides a massive safety net.
Exactly. You're buying $1 of solid earnings for cheaper than you have been able to in over 10 years. But, and this is a really important caveat, this is not a trade for next week.
Right, this isn't a get-rich-quick options flip.
No, this is a multi-year hold. We're looking at a realistic investment horizon of 2026 to 2030. Yeah. You have to be willing to let the thesis fully play out as the buybacks slowly reduce the share count and those new AI initiatives actually gain traction.
It's a true value play for the patient investor. It sounds like the kind of stock you buy, you put it in a drawer, and you just check on it in 3 years.
Exactly. And historically, those are often the investments that perform the best over time.
You know, it really makes you think. We spend so much time in the financial world chasing the next hot AI startup that has absolutely zero revenue. We get so excited about a company that might eventually make money in 5 years. But here we have a company that has literally doubled its cash flow, prints billions in pure profit right now today, and the market treats it like it's radioactive.
It perfectly illustrates the inefficiency of the market. And that is exactly where the opportunity lives. When the entire crowd is looking left, sometimes the smart money just quietly looks right.
So I will leave you with this provocative question to mull over today. When a company doubles its cash flow but the stock price drops to 10-year lows, is the market fundamentally broken, or is it an opportunity staring you right in the face?
Thanks for joining us on Smart Wealth with Joshua.
Don't forget to like and subscribe. We'll see you in the next one.